Welcome to today's webinar, Ask the CPA. You have tax questions, we have answers with our special guest, Micah Frame. This is brought to you by the NFIB Small Business Legal Center. To our current NFIB members, thank you so much for being an active participant in the small business conversation and for your continued support. To those who are not yet members, welcome. And consider joining the nearly 300,000 small business owners who are fighting for small business with NFIB. Our success is based on strength in numbers. Each new NFIB member makes our voice a little louder and strengthens our efforts to fight anti-small business legislation. If you are or know a small business owner who needs their voice to be heard, visit NFIB.com or call 1-800-NFIB now. Before we begin, here are a few reminders. If you have any issues with audio, ensure that your computer speakers are set up properly and know that your internet connection does affect the clarity of sound. We are recording today's presentation, and after the webinar, all registrants will receive a link to the recorded webinar. We encourage you to enter questions in the Q&A box on the right of your screen. Just click Ask a Question, type your inquiry. We will address questions throughout the program. We typically get hundreds of questions during these webinars, so even if we don't get to your particular one, we hope we will answer one that will be helpful to you. And now I'd like to introduce our special guest for today, Micah Frame. He provides comprehensive CPA services to individuals and small businesses, including accounting, tax preparation, bookkeeping, and payroll services. An Amazon best-selling author and financial expert featured by Time, MSN, NASDAQ, Fox Business, and Yahoo Finance, Micah provides personal attention and expert services to each client. Frame, Cawley, and Company, CPAs, can assist with all phases of tax preparation while helping you harness the power of modern accounting. And excuse me. And today we have Holly Wade, Executive Director of the Small Business Legal Research Center. I'm sorry, the Small Business Research Center. And now I'll hand things over to Holly. Thank you so much.
Thank you, Casey, and hello, everyone. Thank you for everybody who is listening to the webinar live, and also to those who are listening to the recording after. I'm happy to be filling in for Elizabeth Melito today. But before we begin, I do want to mention our next webinar in the Legal Center series that will be held on Wednesday, April 2nd at 12 p.m. Eastern Time. So the Legal Center has a webinar every month. It's the first Wednesday, and the next one will be on April 2nd. And we are excited to have Tim Coons join us to answer questions related to employment-related legal topics. So the next webinar will be related to employment law. And again, all of our webinars are recorded, as Casey mentioned, and available on demand if you would like to rewatch any of our past webinars. And you can find them on our website at nfib.com. So as tax day approaches, although we know tax day is for many is an ongoing throughout the year, not just on April 15th, we again wanted to provide realistic and helpful information for small businesses, small business owners as we move into 2025. NFIB is thrilled to have Micah back to talk through small business tax planning. So we've received a long list of questions from small business owners already, which I think will be a great way to cover a lot of tax-related topics moving through those questions. But again, if you have any questions that you think about through the discussion, or you already have questions that are tax-related, please enter them in the Q&A box, and hopefully we will be able to get to them during the webinar. So let me stop sharing my my screen here, and we will get to these questions. So thank you so much for joining us, Micah. It's great to be with you again. And as soon as I pull up these questions, we will get started. Although I thought it might be interesting to start off with, what are you hearing from small business owners? What are they asking? What are some common questions that small business owners are asking you that are tax related going into 2025? Do you hear any themes that are particularly challenging for them, or they have a lot of concerns or questions that they're asking?
I mean, the main things that we're hearing are it's always going to be corporate structure. That's probably the thing that's wrong more than anything else. We do a lot of our work and we earn our keep at the beginning of an engagement because so much stuff is structured incorrectly. So the right business structure, the right salary level for that, things like that. The newer thing that we're kind of having to plan with for people and warn them about is that the qualified business income deduction, which has been around since 2018, that is, supposed to sunset at the end of this year. So the 2025 tax year, unless it gets extended, will be the last year that we get that 20% deduction. So when you're filing your taxes this time next year, you'll still have it. But for the 2026 tax year, it's set to be gone at least. So a lot of the ways that we've set people's salary levels, the way we've structured things has been based on optimizing for that, which our strategies are going to have to shift a decent bit for a lot of people if that does go away.
No, that does make sense. There is certainly a lot of concern about the tax implications if they don't preserve those tax provisions from the 2017 Tax Cut and Jobs Act that will impact all those pass-through businesses out there, which are most small businesses.
Right.
So talking about the structure, business structure, we do have our first question. And she asks, I recently purchased a second deli. Congratulations. And I'm basically doubling my gross revenue to roughly $850K with 2 locations. Should I switch my LLC to an S or a C Corp? The reason I'm asking is because the LLC set taxes. So when it comes to structuring a business, the legal structure of a business, and also with obviously the tax implications, how would you answer Elsie's question?
Yeah, so the main thing that we look at is for any business is going to be the profitability. So people will cite revenue all the time, which I get because that gives you an idea of the scope and scale and everything that you have going on. But from a structure standpoint, most of the time we're going to be determining the right structure based on the profit that you have. So my guess is, assuming there's decent margins on this, I'm going to guess that an S Corp is going to make the most sense, but this will probably be the longest answer I have by a mile because it's kind of going to get into like foundational things of here's how the sole proprietorship works, here's how an S Corp works. So maybe we'll break it up a little bit, but for the initial, I've got a atrocious looking graph that I've made that I've used for the past 10 years, but that generally gets the job done. So here we go, window. So on the left, this is how a sole proprietorship, a partnership, or a single member LLC single member LLCs default to what they call disregard entities. So legally, you've got LLC protection. For tax purposes, you disregard the entity and you act like it doesn't exist. So that's going to be the structure that you have right here. So with a sole proprietorship or a single member LLC, every bit of profit that you have in the business is subject to what they call self-employment tax, which is the employer and the employee halves of Social Security and Medicare. So that's 15.3%. So you're going to pay 15 grand before you even pay your federal and state income taxes. So at this level, it's really a no-brainer to go to the S Corp. And the S Corp is what we've got on the right here. And all we're doing in this is we're taking that same $100,000 and we're splitting it into 2 buckets. So you'd give yourself, in this scenario, a $40,000 salary. You'd have to run payroll for this. You get a W-2 at the end of the year. That's still going to be subject to that 15.3%, but whatever is left over afterwards bypasses that surcharge entirely. So in this case, this person is paying $6,000 instead of the $15,000. So usually I'll say at the break even for that to me is usually around 50-ish grand of profit, because you do have to pay for a corporate return now. You've got to run payroll for yourself and pay a payroll processor. That's going to cost you a couple grand. And where we save the money is the difference between the salary you give yourself and whatever profit's left over. So if you have a $20,000 profit, we can't give you a $1,000 salary, and it's not a reasonable salary, and there's just not enough of a difference anyway to justify the costs. So that's what I would say initially, is that the S Corp would make sense for the majority of people if you're making over $50,000 in profit. That's kind of a long-winded answer, so maybe I'll give that a minute before we get into there's some ways to optimize the S Corp, and then I do have some things. There was a question on C Corps. I've got some other stuff I can get into, but that was already fairly lengthy, so maybe we circle to that later. I don't know.
Sounds good. We'll probably return to a conversation that will expand on that. It can be pretty complicated and a lot of information, but very helpful. Another question from Robert. He's asking about a business that he lost to arson in 2021. They lost signed contracts, documentation, fixtures, equipment. They are back up and running. They're operational now. But the question is, are there catastrophe loss provisions with regards to filing taxes when a business is under these circumstances? Is there anything he should be asking his tax preparer about?
There's some things that you could look at. There's not really, for lack of a better term, there's not like a business interruption insurance type of thing when it comes to your tax return. They're going to say, okay, you were out of business for this period. Your deduction is the fact that you didn't make any money during this period. They don't let you take a bonus deduction for the lost profits that you would have had. Depending on how the insurance paid out, and the way that you've deducted the things in the past, you could do a casualty and theft filing on your return, which can be beneficial. A lot of people, when they redid the tax code back in 2017, 2018, unless you're in a federally declared natural disaster area, for personal losses, they just got rid of casualty and theft losses. So people think those are gone, but there's an exception for if it's a business loss, if the loss is tied to a business, or it's tied to a for-profit activity. I keep getting a ton of people who got involved in crypto scams where we're able to take this loss because it was a for-profit activity. So that's depending on, you're limited to your cost basis with those when you take that theft loss. So it kind of depends on if everything was fully depreciated. It would depend a little bit on your situation, but that's the thing I would be looking at is there potential here to take that theft loss and front load the losses for the things that you lost due to the arson but weren't reimbursed by insurance.
Great, thank you for that. Harper's asking a more general question that I think a lot of small business owners typically think through. What are the most common write-offs for small businesses, and what are lessons known or lesser known ones that might not be taking advantage of?
Yeah, so I mean, the main thing again that we'll talk about is that's not exactly a loss, but is the correct corporate structure, because it's almost like magic. You just change your corporate setup and all of a sudden you're paying a lot less in certain types of taxes. Beyond that, we came up with a list. I'm not sure, I'll probably put this in the chat here, but a few years back we wrote an article on this that it has a list of different things with advertising, bad debts. If you're on there, a lot of people will not think about their mileage expense. That happens quite a bit, where that people won't forget major expenses that they had that came out of their business accounts. It's, if you're doing your books correctly and you're reconciling your bank account, you're not going to miss those. But sometimes people will have a ton of mileage that they have that well exceeds the cost of their of the actual expenses. And sometimes the actual expenses are being run through their personal account because they use the car for personal use as well. So this is kind of just a list, and then we have some expansion on whether or not you should take the mileage rate, use the actual expenses. Some of the other things that that people will forget about a decent bit will be expenses that you're already spending. You already have already. You can take the business percentage of your cell phone bill, business percentage of your home internet bill. There's one that I'm not a huge fan of, the home office deduction, for a fair number of reasons, but one of the things that people really don't utilize is called the Augusta rule. And with the Augusta rule, this goes back to the Masters in Augusta, Georgia. You had people who were renting out their houses during the tournament and making crazy money on it, but then were never renting it out the rest of the year. So they came up with this rule that if you're renting your residence for 14 days or less during the year, you don't have to claim it as income tax on as revenue or income on the personal side. So what you can do is people can rent out their residence to their business 14 days of the year, get the deduction here, not have to claim it over here. The other main one, you have to be a pass-through entity to do this, and it can't be a single member LLC, it has to be an S Corp or a partnership. But when they redid the tax code a few years back, they had what they called the pass-through entity tax election. So again, this all gets kind of like foundational, just like rattling off a lot of stuff. But when they redid the tax code, they capped the amount of state and local tax that you could take on your personal return at $10,000. And especially people who are in high tax states like New York, California, this was really upsetting because they might have been paying between their property taxes and income taxes $40,000. So what a lot of states did, I think almost every state that has an income tax except a couple, they came up with a partial workaround with this that allows you to, on your business profits, on an S Corp or partnership, you can have on the profits of that business, you can have the entity pay the tax and have it paid at the entity level, which then makes it a deductible business expense. That came out you started seeing most of those around 2022, and it's pretty surprising to us how few CPAs are utilizing it. So that's another one that's kind of an easy one to look at if you're an S Corp in an income tax state.
Very helpful. Just to follow up on the home office deduction.
Yeah.
Just briefly, what are a few reasons that you mentioned? There were a few reasons that you aren't a fan necessarily of taking advantage of that.
Yeah. So audit risk has gotten a lot low, and the IRS does way less enforcement activity than they used to. But for a good while, it was an audit red flag, did increase your chance of being audited. A lot of the expenses, I'm more a fan of the Augusta rule anyway, because a lot of times you can get a higher amount with that than you could with the home office deduction. If you take it and if it is audited, there's a really good chance of those expenses being disallowed. That was a big reason the IRS went after it so heavily for a long time, is that when they actually looked at, is this regular and exclusive use? Is this tied to the business? When you look at all those things, a lot of people didn't qualify and they lost it. The main thing, though, that I don't think people talk about a lot is depreciation or capture. So this isn't a big issue if you rent your primary residence, but if you own it, it is. Because when you're doing the home office deduction, unless you're doing the simplified version, which I think is like $5 a square foot, capping at $1,500. If you're doing the regular home office deduction, you have to depreciate if you're saying you're using 10-20% of your house for the home office, you have to depreciate 10 to 20% of your house when you're taking the home office deduction. So maybe that's cool for a little while because, $2,000 deduction this year and $2,000. But then when you sell your house, what would have been a totally tax-free event previously, if you're single and you made less than $250K profit and $500K if you're married, all of a sudden you've got to recapture. Let's say you did that for 10 years, you've got to recapture $20,000 of depreciation all in one fell swoop. So if you're a renter, I don't hate it nearly as much. But if you own your house, that's one of the things that people really do not plan for. And then you do that for 20 years, and all of a sudden you've got a huge lump sum tax event that I typically would rather avoid.
Well, that makes a lot of sense, and it is so complicated, as many of these things are.
Yeah.
One that's in the Q&A chat, and we've been asked this question a number of times, is, a lot of business owners have kids that work in their business. Is there anything to think of when you are hiring your kids, or your kids are working in your business, as far as tax implications?
Yeah. So, I mean, the main thing is that the kids actually have to be working in the business. You've got to pay them a reasonable rate. There's one person who did not become a client a few years back because they wanted to hire their kid to be a model for the website and pay them like $10,000, and the photo shoot took an hour, and the kid had never modeled before or after. Like, it's got to be sort of an arm's length rate for what you're paying them to do. But if you're going to do that, there's a couple things that typically will tie that strategy to. So if you're doing it from your incorporated business, you've got as an S corp. If you pay them under the standard deduction, which I never remember what the exact number is, but for single filers, and that was $14,600 for 2024. If you pay them less than that amount and they've got no other sources of income, that's going to be completely tax-free to them. So you're moving it from this bucket here over here, you get the deduction, they don't pay the tax. You are going to have to pay Social Security and Medicare on that. So that is, partially offsetting. So you've got to be in a high enough tax rate to, you're paying 15.3% here, your marginal tax rate needs to be higher than that to justify the maneuver. If you do it through an unincorporated business, if you do it through like a family LLC, you don't have to pay the Social Security and Medicare on it. So a lot of times people will do that, but you've got to do it correctly. Sometimes people just want to do it like it's an on-paper transaction where they've got the side LLC that has no activity. And there's some steps we want to go through for it to be compliant. But the other main thing that we'll talk about is that is a really good opportunity for them to contribute to usually a Roth IRA. So if you're going to go through with that and you've got the liquidity, you can pay it to them, either paying the self-employment tax under a corporated business, under a family LLC. You don't pay the Social Security and Medicare. But then you can do $7,000 a year into a Roth for them. And if you're doing that, maybe try to make it harder for them to know that exists and to access it. But you'd really be setting them up for success in retirement, because you've got a 13-year-old who's already starting to contribute pretty heavily to retirement.
That is fantastic information for those who want to start their kids' retirement savings early. So another question, going back to S Corp structure, Dwayne's asking, how exactly are distributions handled in an S corporation taxes? Is there a form that officers get to claim it on their personal taxes? And can you explain how distributions work in an S corp?
Yeah, so this we get asked all the time, because people will, sometimes they're really heavily leveraged. They had to pay down principal on their business loans, or sometimes they just leave all the money in the business. But they'll say, hey, we say, all right, you're getting taxed on the $200,000 profit that your business had this year. And they say, whoa, I only took $50,000 out. Why am I being, I should only be taxed on the $50,000. That's not the way it works in an S corp or any pass-through entity, because what they're taxing you for on the S corp is the profit of the business. So they're going to look and say, okay, what is your net profit? Okay, that's what you're getting taxed on. They don't care if you left every dime of the profit in there. They don't care if you took every penny of it out. They're going to tax you on what the profit is. So that's the downside. What people will typically be thinking about is a C corporation when they think about being taxed on the distributions themselves, because in a C corporation, the corporation will pay its own corporate income tax, And then when the shareholders get dividends, then they're taxed at the individual level again. So the shareholders are only taxed on distributions, but you're being double taxed because the corporation already had to pay the tax here. So it's not a tax advantage way to do it to be in the C Corp, but I think that's the big disconnect that people will have.
Okay, that makes sense. Back to the Q&A box. Again, if you have questions, please submit them in the Q&A box. One question is, what are some strategies for offsetting large short-term capital gains? Buy land, develop land with more storage unit, buy equipment. What would your suggestion be in this situation?
All right, so what are some strategies for offsetting large short-term capital gains? I mean, that largely gets into what you're investing in, I guess. Like that's where it gets a little bit tricky because short-term capital gains are not tax advantaged. So if there's anything we can do to offset against them, that's great. But you're going to have to deploy capital somewhere. And with capital gains, I guess, and especially short-term because they're taxed at ordinary income tax rates, that's not in its own bucket for the gains. You could use most things except for rental losses against that. So if you're reinvesting in your business and you buy a bunch of equipment, you depreciate it down, those are going to fall, those are going to be taxed roughly the same. Depending on the level, your income tax level, you could look at land conservation easements. You can look at like really tax-centric investments in theory, but you've got to make sure that where you're deploying the capital makes sense. And that's kind of what I'll talk to with clients a lot is when they don't want to pay the tax, which I fully understand. It's the whole reason they hire us. But it's like, okay, if you spend the money here, is it a good investment on its own? With the tax savings, is it a good investment? So that's kind of a rambling answer, but there's a lot of different ways you can do it, but it has to be fundamentally sound from like a financial and business standpoint first. Otherwise, you're just way better off paying the tax.
Okay, very helpful. Switching gears a bit, there's a question that was submitted about health insurance. And Jean is asking, she has a small business of 5 employees plus herself. It's an S Corp. And what health benefits are available for her to offer her employees besides group health insurance plan? All but one person is covered by their spouse. And are there any other kind of benefits, tax situations where she can offer something to her employees in the healthcare space outside of the typical group plan that's so expensive for many small businesses?
One of the things a lot of small businesses will do, and I don't think you're not even required. This gets a little too more into the health insurance side. It's not my area. I'm mostly sure on this that you don't have to offer group plans to do it, but you can still offer a flexible spending account for your employees, even if they're not covered by your insurance. So an FSA, it's somewhere in the neighborhood of, it used to be $2,500. It's gone up a little bit, but they can contribute to an FSA, and then that gets reduces their taxable income by the amount they contribute, and then they can use that money tax-free for any qualified healthcare expenses they have. You can also set up what they call a dependent care FSA. That's $5,000 a year. Very, very similar setup to where it becomes a pre-tax contribution to where if your W-2 or the employee's W-2 is $50,000 and they do $5,000 into it, they're only being taxed on $45,000, and they can use that to pay their daycare provider, preschool, whatever that is. Beyond that, it gets a little. I think they've got some really de minimis things, like you can do like commuter plans, or you give somebody rides a bike, they can get like $25 a month. Like there's some smaller things, but most of the small businesses we have don't offer group plans because it's just cost prohibitive, but they might do the different types of FSAs. And a lot of times they'll set up a retirement plan, be it a 401k or a simple or something like that, and they'll do you can do a 3% match on wages, which obviously, and you could do more than that obviously, but usually that's kind of the ballpark minimum. And that way you're at least providing some sort of array of benefits versus saying, no, we don't give you anything. So that seems to help with employee retention. But if you want a deeper dive, you talk to a benefits expert, a health insurance guy.
Great. Switching gears again, when does the alternative minimum tax come into effect? One of the more complicated tax measures. And we are a C Corp and we do not owe taxes due to large equipment purchases, but they're asking about the alternative minimum tax and when that kicks in.
I'm gonna be honest. I'm gonna have to really brush up on my AMT rules if the current tax code doesn't get extended, because AMT used to be a much bigger deal because they basically from 2018 to 2025 they raised the threshold sky high to where for most people it is not a factor. But if it reverts back to where it was, I need to find it because we did an article when years ago when the tax code came out, but AMT never got indexed for inflation. So the levels it was, and I think it was like they came up with AMT in like the 60s or something. So people who are making very ordinary incomes were getting hit with it when if you had adjusted it for inflation, it would have been, it would have been 5 times the income or something like that. So AMT is sort of a tax code that runs parallel to the regular income tax codes and will effectively disallow certain deductions. It doesn't allow you as favorable depreciation. There's some other factors on it, but most people don't have to worry about it. But it is going to be a huge pain because people have largely forgotten about it because we've been under this tax code now for almost a decade. So right now, you don't worry about it most of the time, but you might. I think like I said, I'm going to have to brush up on that and run some significant planning scenarios for clients if it goes back and reverts to its old setup.
Yeah, I think you and probably every other CPA in America will have to brush up on what that is again and how it impacts small businesses. So Mary's asking if you can explain what determines pass-through income and non-pass-through income and their effects on personal taxes for an LLC. So is there general definition of that's easily explained pass-through, non-pass-through income?
Is it passive?
Passive income, sorry.
Yeah. No.
I say pass-through income 1,000 times a day, so passive income, correct.
I mean, there's some parameters. I can pull up the full list of them later, but it's largely, you've got 2 main criteria. It's active participation and non-active participation or passive. So if you have a business or a real estate holding, and the closer it is to owning a stock, the closer it is to just owning an investment where you're not doing anything in it, that's passive involvement, that's passive income. And what happens with that is there's a few things. One is that the real estate is sometimes, even if you mark it as active, as passive, but it gets, for business income at least, the way that that's going to work is that at higher income levels, it's going to be subject to what they call the net investment income tax, which is that Obamacare era tax of, I don't know, somewhere in the ballpark of 4%. I'm the worst at actually know, it's like 3.9, somewhere in there. I never memorized the numbers. I'm more on the strategy of it. But if you have an S Corp and you have S Corp profit or partnership profits from a business, and you say that you materially or actively participate in it, you don't pay that 4-ish% surcharge. If you're a passive investor and you're above those thresholds, you do pay that. The other thing is on business losses, you've got what they call, passive activity losses. So if you have a business that you're not actively participating in and it loses $100,000, you're not going to be able to use that to offset against ordinary income. You're not going to be able to offset against dividend income, your W-2, regular business income. It just sits there. They talked about having a pig for every cow. You need a passive income generator to use your passive activity losses. Certain things like real estate, even if you're actively involved in it, unless you're a real estate professional, gets kind of held in suspense the same way. So that's what will happen with passive activity losses, is it's not that they go away, but they get held in suspense until you either dispose of the asset or have a passive income to use to offset against it. It's kind of the quick answer on typically how that works.
Great. So here's a question from Donald, and back to the program that was so helpful but so complicated, the employee retention credit.
Yeah.
So he is asking that we applied and received the ERC for the year 2020. We did not receive the funds until 2024. I am being told that we must file and amend 2020 tax return and pay the penalty. I greatly question this issue. We did not file and did not receive funds until 2024. What does he do?
This is the most obnoxious treatment that they put on this, because what he's being told, unfortunately, is right. Because for most things, when you get a program like this, you're either allowed to amend the return the year that it's tied to, or you just you claim the ERC income when you actually received it. For whatever reason, with the ERC, they don't give that option, and they force you to amend these prior year returns, and pay the tax, and then pay at least on the federal side, that you don't get hit with a penalty, because there was a revenue procedure or some bulletin that was put out by the IRS that says for the ERC, since it didn't exist in 2020, that you don't have to pay the penalty on it, but you do have to pay the interest, because the interest is statutory. I think that is required. And when people received the ERC money, they didn't realize this at the time, but they were getting interest on, this was from a 2021 filing. They got interest as part of those lump sums that they were receiving a few years later. So unfortunately, that is the procedures. You have to amend the entity return, your individual return. If they try to charge you the penalty, some states, I think, have an equivalent procedure to the IRS where they say they're waiving the penalties. Some states don't have anything about it. So you might pay a penalty on the state side. You shouldn't pay any penalty on the federal side, but you are going to get hit with interest. It was free money in a lot of cases. Like, it was still, like, on balance, you're still better off, but it is super frustrating. And I don't know why they didn't just give people the option to claim it as income when they actually received the funds.
That would have been hugely helpful for a
so
whole lot of
easier.
small business owners. Oh my gosh, but can't make things simple these days.
Yeah.
Or back when they designed the program.
Right.
Sarah's asking, when you receive money from an insurance claim and you don't use all of it on the repairs, is the net income of that insurance claim taxed?
Yeah, and the majority of I guess as a category, it wouldn't be revenue or income to the extent that matters with your business licenses and thresholds of that, but it is a reduction. The check you receive is a reduction to expense. Let's say it's a reduction to repairs expense. So if you got a check for 20 grand and only spent 5,000 of it, on your return, you'd be showing a negative $5,000 of repairs expense, which then would increase your bottom line net income. So it's not revenue, but yes, it will increase your profit.
Okay. Moving to credit cards. And so Jeff's asking, using a personal credit card for business and using business income to pay that credit card, that personal credit card, is the payment from the business account considered personal income or business expense?
I mean, the payment is never going to be a payment of a liability is never going to be an expense. So, I mean, the cleanest way to do it, especially because now they do have credit cards that have pretty decent, usually it's cash back because why people are doing this. And a couple years ago, your best cash back or rewards card outside of an Amex was going to be like 1% cash back. Now you've got Capital One has a Spark card that gives you 2% cash back with like $100 fee a year. Like you've got some cards that have decent rewards now. It's a lot cleaner just to have it all done on have a designated business card and just do it that way. And it's also a lot cleaner from a bookkeeping perspective, because if you're doing it on a personal card, assuming there's any sort of intermingling of funds, there's a good chance that you're going to miss expenses because you're not reconciling your card every month and knowing that everything that happened on this card is a business expense. So that's the way I would advise doing it and moving going forward. But if you're not doing that, and for historic, where you've got all these personal charges, you would basically you would have to itemize all of those specific charges in there. And I guess you could do a journal entry or a payable to yourself or whatever, but you've got to do it by category, where this is what I spent on vehicle and this is what I spent on office supplies and everything else. And then the counter journal entry to that would be an owner's distribution, because paying a liability, whether it's owned by the business or you're paying your personal card itself, is not an expense. It's a reduction of a liability. So I think it's making it harder on yourself. But yeah, if that's the way you're doing it, that's the way I would be booking it to make sure you capture the expenses.
Helpful tip. Lisa is asking about from the Q&A chat. She's a social media content creator making a profit. It uses animals that have been acquired on their small hobby farm solely for the subject content, as well as a couple family pets, and want to expense the costs of the upkeep of the animals. Can all of this happen on a Schedule C? These type of expenses?
All right, I'm just reading it. Social media content creator. Pets are tough. Pets are really tough. Again, we did an article on this way back, because all the time people my dog is in the office with me today. People will have, you go to a bookstore and they've got the cat that just lives at the bookstore. Pet deductions are really, really difficult, because you have to prove, same as other business expenses, but the burden is just higher, that the primary reason that you have the that you have the pet is because of the business. So the examples that you're okay if you train guard dogs. But if you bring your dog to the office and they bark at the people coming in, that doesn't qualify. So I'm trying to find. It's been a while. There's one example where I think the IRS took it to court, where somebody had a cat that was like it was a mouser and the barn, and he was deducting the food for it, and the IRS tried to disallow it, or maybe the IRS said that it was okay, but yeah, it's very, very limited. So if you've got anything that is making it approach to where this is your, I found the article, I will link it here just for the sake of time. If you have anything that is remotely close to this gives me personal enjoyment, there's a really high burden, and it's similar to cosmetic procedures. If you want to deduct a cosmetic procedure, you really have to prove that this is exclusively for business purposes, that provides you no personal benefit or general well-being. Otherwise, it gets stricken away.
Okay, very helpful. Vicky is asking, she's selling a solar investment tax credit. She files as a sole proprietor, and she's asking what tax form is required to document the sale.
I don't know. I've only had to deal with like one of those. I'll look it up. I've had very few. The one thing that I will say is that it's only specific solar credits you can sell. I had one client this last year who got sold on doing it thinking he could transfer it, and it was a residential energy credit. The residential energy credits you cannot sell. So their income is low enough that they're not going to be able to, they have like a $30,000 credit that they're not going to be able to utilize for like 10 years basically. So just make sure when you're talking to solar companies that is one of the ones that is transferable.
Good tip. So back to S Corp structures, C Corps.
Yeah.
Paul is asking, is the S Corp structure actually better than a C Corp for reducing taxes? What are the general pros and cons that you would talk through a business owner about those two different structures?
Yeah. So this is one we've talked about and done a lot of planning with since they dropped the corporate tax rate down to 21%. Because a lot of these like online gurus, like Facebook marketers will love to give like hot takes that are horrible. And they're like, hey, if you're making any sort of money, 37% tops tax rate here, 21% at the corporate rate, do this. And that ignores a lot of like the very like the basics of how it works. So I was doing a presentation a while back. I think kind of walks through one of the things for optimizing an S Corp, and also kind of comparing how the tax works between a C Corp and S Corp in similar situations. So first I want to talk about optimizing for QBI, the qualified business income deduction. And the way that QBI works is that it is up to 20% of the profit on your business return. So on $500,000 profit, this person could get an up to $100,000 tax deduction. The problem is that higher income levels, it starts to get phased out based on 50% of the wages that were paid from your entity. So when this first came out, I had a client who made $500,000. Previous CPA, he only had subcontractors. Previous CPA didn't have him running any sort of so let me make sure I'm sharing the right. I'm not sure if I'm sharing the right screen. There we go. Didn't have him running any sort of payroll, so he should have gotten $100,000. Instead, he got 50% of the $0 of wages he paid himself. So that's one of the things that we'll do with people who are making, usually if you're single over like $200,000, married, it's about $400,000, is finding the sweet spot for how much you do between your W-2 and what you take as distributions. Because the old strategy was always to anchor the lowest salary you could, because then that would reduce Social Security and Medicare. But in this scenario, this person making $500,000, their sweet spot is $150K salary, because even though it's costing them 20 odd grand in Social Security and Medicare, it's saving them 25 in their federal income tax. And as this scales, the savings only get higher and higher. At $1 million, your sweet spot would be a $300K salary, and that would reduce your liability somewhere around $30,000 versus paying no salary at all. So most people, optimizing for QBI is really important. So anyway, getting that sort of like vaguely foundational. Let's say you're making 500K profit. Every bit of that profit in a C Corp, you're going to pay 21% corporate tax rate on it. So the pure income tax on that is a little bit lower than the S Corp. What they don't talk about is that if and when you take those distributions, you're going to pay the tax again at the individual level. So at this 500K level, even accounting for the Social Security and Medicare, because you're not required to pay yourself a salary if you don't want to on a C Corp, this is still costing you a pretty significant amount of money, or somewhere in the range of 40, 50 grand. And what beyond the QBI optimization, they don't talk about how we have on the individual level, we have a progressive tax rate. So you're taxed at $0, then 10%, then 12%, but it's in different tranches. So income from, let me see, I think I pulled that up. Yeah, so if you're single, income from taxable income from $1 to 11,000 is 10%. 11,001 is at 12%. 47,001 is 22. So it's not like you hit, oh, I'm in the 32% tax bracket and it's retroactive. These groups are still taxed at a lower rate. So when you look at the blended rate, a lot of times it's going to be less than 21% anyways. And let me get back to the one. So anyway, that usually the C Corp does not make sense, because if and when you take those distributions, you're going to get hammered. One of the strategies that we will do with people is sometimes if they're starting a second business or they want to split their business into two entities, is taking that and splitting it into a C Corp and an S Corp. And in this scenario, we say, okay, let's split this into two different buckets. It's still not quite as good. On the $1 million, you're still paying a little bit more than you would just on the S Corp itself. So you ask, okay, why do you do this? I'm going through as fast because we're running out of time. But the C Corp is bad typically because you've got to take those distributions. But if you know you're not going to have to take those distributions because you're saying, all right, I'm not going to take this for 20 years. I'm going to live off my S Corp. Then the math starts to become a little more favorable, and you can do kind of a time value of money thing of saying, okay, I've got access to the $60,000 difference for the next 20 years. Then it starts to get more interesting. But typically, for an operating business, a C Corp is a really atrocious idea.
Makes sense. Very helpful. Again, amazingly complicated.
Right. I know. That's kind of fire hose thing, but
at least it gets folks thinking through,
right.
what.
Yeah, I want to introduce the concept.
Absolutely. Absolutely. Well, we are almost out of time, but I did want to ask one final question that I think is often helpful in talking to a tax professional. What do you find are some of the better questions that small business owners ask you in kind of starting the conversation if they don't kind of know where to begin in talking with their tax professional? Because it can be very intimidating.
Yeah, I mean, one of the things that we'll do that I don't think a lot of CPAs do, those kind of keep it as it's moving, is this structured correctly? Is there anything I'm missing? And people will kind of ask it like, hey, are there any deductions I should be taking that I'm not? And maybe there's like a little bit of that, and there are sometimes it's big, but that's only going to get you so far most of the time. But kind of having a discussion with your CPA on, here's the liquidity I have, here's the plan I have for the business. If you have a more comprehensive discussion with your CPA of what you've got going on and what you expect to go on, then you can start to have more meaningful conversations on, is your debt structured the right way? Is your corporate entity structured the right way? Are you paying yourself enough? Do you want to do a retirement plan? What are some investments that might be helpful to you? A lot of times people will And CPAs have not done themselves favors on this because they basically turned into just glorified data entry where they don't do any planning, don't do any advisory work. But a lot of times people look at their CPA as like, this is a tax preparing event. At this point, for corporate return, we won't even take on business owners unless we're doing planning with them throughout the year, because then there's a lot of opportunity. But that's the main thing I'd say, is having meaningful discussions with your CPA as to, is there anything I should be anticipating, or are there opportunities here that I'm missing? And then that can kind of open the door to some more interesting discussions.
Wonderful. Well, thank you very much. And for those who are interested in getting in touch with you, what is the easiest way to contact you?
Probably, we've got a couple websites. I'd say the micaframe.com one. We've got some of our, that gets some of the articles that we have. It'll also shoot you to an intake form that kind of gives us some baseline information that better tells us how we can help you and where the business is at.
Wonderful. Thank you so much for joining us again. This has been hugely informative. And for other questions that we weren't able to answer during this webinar, if you are still looking for answers, please email NFIB at info@nfib.org, and we will get to the remaining questions and send you information, or hopefully be able to answer you directly. And with that, I will turn it back over to Casey.
Thanks, Holly, and thank you all for participating today. Visit nfib.com/webinars for all of our webinars on demand. That concludes our presentation. Have a blessed day.